After watching this video, I guarantee you would understand everything there is to understand about S corporation taxes. So I want you to stick around till the end of today's conversation. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka. Now let's roll. In today's conversation, I want to explain to you everything you need to understand when we talk about S corporation taxes. Okay, now let me first talk about the taxation model. It's very important. So S corporations, they don't pay corporate income taxes. This is really important. So there's not really an S corporation tax rate. This is important. So instead, what happens here is that the company's individual shareholders split up the income or losses among each other and report it on their own personal tax returns. So this is their own personal 1040s. Okay, so unlike regular corporations, C corporations, they don't actually have a double taxation, because when we talk about double taxation, we are speaking about how income earned by a regular corporation is technically taxed twice, right? Once when the company earns income at the company's level, and again when it distributes dividends to its owners, who then pay taxes on those dividends. So S corporations avoid this business tax by passing their income through their business owners directly as reported on something called Schedule K1. So this is why we sometimes, not just we, I mean everybody refers to S corporations as pass-through entities. Very important. Now, let's just elaborate a little bit more. So the thing here is that if you are an S corporation, you definitely are avoiding double taxation. So when we have a C corporation, that corporation is taxed as its own entity. So the company will file Form 1120 each year to report its income. Okay, it will also report its deductions and credits. So we have the companies filing its own taxes. But if you are, let's say you are a small business owner and you expect to put some of the end of the year's profit into your own wallet, the money could end up being taxed twice. So this is if you have a C corporation. But if you're an S corporation, you only have to pay taxes at the personal level. So let's say if you are in the 25% or 30% tax income category, the rate category, you only have to pay 30% on that profit, on that corporate profit. So this is really good. So when we talk about pass-through taxation, this is the key difference between a C corporation and an S corporation. But there are a few other key details to understand about S corporation. So you are also able to pass a loss onto your personal income taxes. Very important. Okay, if the business has a loss. And stockholders are required to report their percentage of the profit or loss on Schedule K1. Another thing that we also love here is that now to qualify as an S corporation, your company needs to be a domestic corporation. Shareholders cannot be partnerships, corporations, or non-resident aliens. You cannot have more than 100 shareholders. That's a limit that the IRS actually has. You can have only one class of stock, and you need to be an eligible corporation. So some financial institutions, insurance companies, and domestic international sales companies are not eligible. So let's talk about S corporation election. So how do you actually elect S corporation status? So to file, in other words, to elect for S corporation status, your business must be first incorporated as a regular C corporation or have filed for LLC status. Okay, so LLC means what? Limited liability company. Remember, S corporation status is a tax designation. You cannot incorporate as an S Corp. I mean, incorporate, quote unquote. Okay, so it is a tax designation. So if you are electing S corporation status as a C corporation, you must submit Form 2553. So you can see this on the screen. Form 2553, election by a small business corporation to the IRS, signed by all of your company's shareholders. Very important, all of them. Okay, so if you are electing S corporation status as an LLC, you also need to file the same form 2553. Okay, so let's just elaborate a little bit. So when we talk about S corporation versus LLC, you need to understand S corporation and LLCs are similar business structures. Technically, neither of them pays taxes. Okay. Instead, their net taxable income is taxed to the company's shareholders on the personal tax returns. And both are separate legal entities, meaning the owners have liability protection and their assets, their personal assets, that is, are protected. So the differences between S corporations and LLC include that LLCs can have an unlimited number of members, whereas if you remember, S Corp, we are capped at what? 100 shareholders. LLCs can have non-resident alien shareholders, whereas S corporations are not permitted to have any non-U.S. citizens as shareholders. And LLCs can be owned by corporations, partnerships, trust, or other LLCs. So if you are considering incorporating, talk with an advisor to find out whether an S corporation or LLC is the right business structure for you. So here are the requirements for becoming an S Corp. Very simple. Step number 1, you want to become a C corporation or an LLC. Okay, so it's important, as I said before, an S Corp is a tax designation. Okay, so that's number 1. Step number 2, make sure you qualify for S corporation status. I've told you before the requirements for incorporating as S corporation status. In other words, you have to be a domestic corporation. You need to have allowable shareholders. It cannot have more than 100 shareholders in total. It can only have one class of stock. Okay, it cannot be an insurance company, bank, or domestic international sales corporation. And all of the company's shareholders must unanimously consent to S corporation status. Very important, unanimously. And step number 3, you need to file IRS form 2553. So those are the 3 steps you need to follow. Let's have a quick conversation about suitability. Okay, so the question is, should you elect S corporation status? It really depends on you, because people think about, well, S corporation status, the only benefit is I want to avoid double taxation. This is not only the only thing. I mean, it depends on the industry you're in. It depends on the shareholders that you have. Remember, the shareholders must unanimously, collectively agree to the change of status. Very important. So should you elect? It really depends. It depends, for example, on the complexity of the business you are running. It depends on the niche you're in. I said this before. It depends on the states you're in. It depends on what kind of business you're in. So it's a lot better based on our research to have a conversation with a CPA or a tax attorney or any other experts. This can be an enrolled agent to have a clear idea of what your possibilities are, what your options are, what options are there for you on the table. Okay, so you just have to think about whether you want to be an LLC, you want to be a C corporation, or you want to be an S corporation. So the key differences between S corporation and C corporations is that if you want to create a C corporation, you file articles of incorporation in your state. If you want to create an S corporation, you have to incorporate first, then apply to the IRS by submitting IRS form 2553. So C corporations are taxed twice, okay? S corporations are taxed once at the personal level. And now, there are no restrictions on shareholders at the C corporation level. There are restrictions on the shareholder type at the S corporation level. Now, outside investors they do see C corporations more favorably, more positively, whereas S corporations are not seen favorably because of the restrictions, because of all the limitations. Okay, now, so a C corporation is ideal for a new growing business planning on reinvesting profits back into the company, whereas an S corporation is wonderful for mature businesses looking to distribute profits to their owners. Okay, and when we talk about the required tax form for the C corporation, we have an 11 form 20. That's the form. For the S corporation, it's 1120S. But remember that the profit is distributed on Schedule K1, which then pays for taxes at the personal level. Okay, so a C corporation is basically a default type of corporation. Okay, remember, all corporations, even S corps, start as one. And so C corporation, as I said before, they are taxed at the business level, so they have to file Form 1120 Okay, and so they actually pay taxes twice. One thing I want to say here is that an S corporation is just a special tax designation. So please remember that. So if you want to think about suitability, you have to think about what kind of criteria are favorable to your specific type of business, to your specific type of shareholders, to your specific states where you are operating. Let us quickly talk about tax filing, folks. It's really important. How do we file taxes? How do you file taxes as an S Corp? So you have to pay attention to an important form called Form 1120S. So this is called U.S. income tax return for an S corporation. So this is the tax form that S corporations and LLCs filing as S corporations use to file their federal income tax return. So the 1120S is basically a 5-page form from the IRS. Okay, so this is I'm going to show you. I'm going to show you the form really soon. But basically, the form talks about it gives you general information about your business, including your date of incorporation and the date you elected as corporation status, your business activity code, and then your EIN, your employer identification number, a profit and loss statement, and a balance sheet for your business. And it also asks you questions. It also asks you questions about, let's say, any payments you made to independent contractors, totaling at least $600 for the year. So if you have that, you have to file Form 1099 NEC. Okay, so you can see actually on the screen right now. I just want you to look on the screen right now. So you basically have the first part of the form. So you have your, you talk about your company. You put the right information. You put the name. You put the address. Okay, and you say you can see here on HH it says you want to check if this is a final return, the name change, and an address change, an amended return, and S election termination. So put in the right information. So here we have the second screenshot here. So you talk about your income. So we are speaking about all income information, but remember that you are not paying taxes at the income level on income at the S corporation level. Okay, and the third screenshot, this talks about your deductions. So those are expenses that your business, your S corporation, actually incurred during the year. And the fourth screenshot here, we are speaking about the tax and payments. Okay, so this section applies to corporations that began the year as a C corporation and filed for S corporation status during the tax year. Okay, and the last thing you'll need to, so we continue. So here we have a Schedule B. So Schedule B, other information, will ask you a series of yes or no questions about your business, accounting methods, the types of stock it owns, gross receipts, and a bunch of other stuff. You can see on the screen here. And we have another continuation of a Schedule B, so you can see on the screen. All right. And the third screenshot here talks about Schedule B, other information. So those are pretty self-explanatory questions, I would say, comments. If you have any question about any of those, please drop them in the comment section below. We will certainly answer you, not a problem. And here we also have Schedule D. So Schedule D basically is also another type of I would say annex to the form. And we have Schedule D Part 1, and we are showing Schedule D Part B on the screen right now. And you also have we have Part B. This is what it is. Okay. And one thing I want to say here is that those are important schedules depending on your business. We keep moving. I'm still showing you here a Schedule D Part 3 of the form. And now we have Schedule K. So Schedule K actually brings together information about your business income, deductions, and any tax credits your business qualifies for. So you will use actually the information you bring together on this schedule to file a separate Schedule K1 for each shareholder in your S Corp based on the percentage of total shares that they own. So it's important. So when we talk about, remember, I was talking to you about all the shareholders unanimously filing for S corporation election. Here, you want to distribute Schedule K1 to each shareholder who has a stake in the business. Okay, so you can see Schedule K1 here, how it looks like. So Schedule K, you can see here the second screenshot it shows here shareholders pro rata share items. So we are speaking about their pro rata's income, their pro rata deduction, and the pro rata credit. So this is based on the percentage of equity they own into the business. They own in the business, because it's important. So for instance, if they own 20%, you have to actually take the income, deductions, and credits and just multiply that by 20% and just allocate that portion to them. Okay, it's important. So we are moving on right now. So we have here another, so this is the continuation of Schedule K. So it shows here international transactions, AMT items affecting shareholders' basis. So again, here I'm not going to linger on those items. If you have any questions, specific questions, you can drop them below. We will definitely actually answer you, not a problem. So we continue Schedule K. Here we have a pro rata Schedule K pro rata items. So we have a reconciliation and other information, and we also have Schedule L. This is here, Schedule L. And it shows the balance sheets per book. Okay, this is balance sheet per book. So it shows the assets and liabilities of the business. And we have Schedule M1. So Schedule M1 actually reconciles the income loss per books with the income loss per return. So remember that sometimes the IRS has a different accounting methods than financial accounting that U.S. GAAP. So when there is a dichotomy between U.S. GAAP, in other words, U.S. financial reporting standards, and IRS tax accounting methods, so accountants and tax preparers have to reconcile the differences on those schedules. So Schedule M1, it's important, and Schedule M2 actually shows you the adjustment accounts, the shareholders' undistributed taxable accounts, and other stuff. But again, if you have any question, please drop them below. We'll certainly answer you, not a problem. And one thing that you really need to understand is that when we talk about deadlines, so the deadlines for filing S corporation taxes is March 15th of every year. Okay, so the deadline for filing Form 1120 is March 15th of every year. So you can apply for a 6-month extension by filing Form 7004. Okay, 7004, and you can file both forms electronically or by mail. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another session of the Awesome Sweetie Kiwi Show. We are still having a conversation about S corporation taxes, everything you need to understand. Okay, now I really want to linger a little bit on the tax benefits of filing as an S corporation. It's important because if you decide to actually elect for this particular type of corporation, you need to understand that obviously there is some work to be done. I mean, you have to do some work. Remember that the IRS is very adamant at making sure that S corporation are compliant with tax laws. Okay, because remember, we have a limitation on the number of shareholders. So the number is capped at 100. So you got to think about that. But you also have to have a lot of paperwork, because God forbid if you get audited. If your business gets audited, you want to make sure that you prove everything that the IRS wants to see, right? So there are two benefits. There are two benefits, that two primary and major benefits that are attached to an S corporation. So we have the no double taxation that I spoke about before, right? So as I said before, regular corporations are taxed at the corporate and personal level, while S corporation income is only taxed at the personal level. So if your company is making a profit and you want to take some of those profits out of the company, it's generally cheaper to do this as an S corporation. And the second important tax benefits is the absence of self-employment tax. So there is no self-employment tax at the company level. So unlike owners of sole proprietorships, partnerships, and LLCs, S corporation owners only pay self-employment taxes on their wages instead of their entire share of the company's profits. Okay, so all other income is paid to shareholders in the form of distribution, quote unquote distributions. They are not subject to self-employment tax, which makes S corporation status very attractive to many small businesses. Okay, so let me give you an example. Let's say you have a 50% ownership stake in let's say in John's Sandwiches, which is a successful chain of sandwich shops that recently filed for S corporation status with the IRS. Okay, so as CEO and founder of John's Sandwiches, you earn, let's say, $50,000 this year, and the company also earned a net profit of $250,000 a year this year, which means you are entitled to 50% of that profit, which is what, $125,000. So because the John Sandwiches is an S corporation, you only have to pay self-employment tax on the $50,000 salary and not on the $125,000 distribution. It's very important. Let me give you a few warnings, though. I mean, I've spoken about the benefits of S corporation taxes. This is really cool, but there are some limitations. Actually, there is a catch, and you may wonder why S corporation owners they just don't take a salary of $0 to avoid self-employment taxes altogether. The catch here is that if you are a shareholder and an employee of the company, which most small business shareholders are, you must pay yourself a reasonable salary before paying yourself a tax-free distribution. So basically, what is exactly a reasonable salary? I mean, a lot of experts have debated about the issue in the past, but the question is it's still out there. The jury is still out there in terms of what qualifies as a reasonable salary, because it depends on the location. It depends on where you live in the country. It depends on your lifestyle. It depends on what kind of niche you're in. It depends on the company's profitability. Okay, the IRS has no hard and fast rules they have no hard and fast rules for this particular question, but you should try to base your decision on position, experience, business size, and what a comparable position at another company in your industry will earn. So whatever salary you decide on, be sure you are able to justify to the IRS if you ever get audited. It's important that, like we said, S corporations are a very particular type of corporation, so the IRS pays attention a lot to the mechanisms that underlie the company. So you also need to watch out for different state rules, because while these tax advantages might make S corporation status attractive, S corporations are not treated equally by each state. For instance, some states choose to follow the federal tax requirements for S corporations, while states like New Hampshire, Tennessee, and Texas ignore S corporation status, and they do tax those companies as C Corps. So bottom line here is you want to actually enlist the help of an expert to have a clear idea of what kind of rules I think apply to you. Okay, reach out to a CPA, reach out to an EA, an enrolled agent, reach out to a tax attorney, or anybody who has any professional who has expertise in the subtleties of corporation taxes, especially S corporation. Very important. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about S corporation taxes. So we spoke about the taxation model, the S corporation election, the suitability, the tax filing, the deadlines, the tax benefits, and I'll give you a few warnings so you have a clear idea of what to do and what not to do. Thank you so much. God bless you. I'll see you next time. But until then, remember, stay marvelous.